One of the main things in trading is protecting your risk. And I will always say that is your number one strategy. Don't think about what you think the market could go to or what coffee could do tomorrow. Always think in your mind, what is your max pain? What is your loss that you can endure while still riding out a trade? So let's say, for instance, you want to get long the S&P 500. You only want to risk a certain amount of money to do it. So therefore you put a stop loss based upon the money you want to risk. This is, in my opinion, a faulty way to go about things. The markets are really, really good at going up and down very fast. And what this does is it triggers stop loss orders, whether it be to the shorts that are getting taken out to the upside or the longs that are getting taken out to the downside. Strongly consider that although stops are a very, very useful and integral way to do things, strongly consider using put or call options to protect your position. A case in point is this. Let's say you are long the S&P 500 at a certain price, and you think it could go lower. You're afraid that it would, so you put a stop loss order 10 points below. 10 points in the S&P 500 being $500, $50 per point in the S&P. Is it likely that 10 points in the S&P is going to get hit? Yes, very, very likely. So your uncle point is $500 away. Consider, and this is not financial advice, consider using $500 to buy put premium just in case the market goes lower. That way for you, you have bought a predetermined amount of time that you've bought at a particular strike as well to ride out downward price movements in the S&P 500 in that contract that you are long. This is very, very important. One, when VIX is low, you can buy protection when it's cheap. And two, because you need to take your emotions out of the game. Set it and forget it. Know how much you are risking. Know what your max pain will be. And you can then turn off the TV and let that trade ride for a particular amount of time. This will save you gray hairs, and it will also save you, very likely, the ability to manage your risk. I'm not going to tell you it's going to save money, but I want you to do your own calculations thereafter. You can spend your time doing other things. You've already spent your time making sure that trade is the one you want. Manage the risk with either, if you're going short something, consider buying calls. Just in case the market goes against you significantly, buy those call options. And if you're long something and you're worried about the price going lower, consider buying a put strategy or getting long puts at a particular strike price and a particular amount of volume and time left. Then you'll see the utility of options and the ability to say, I don't care where the market's going to go from here. I think X, my risk is Y. Now I can step away. If you have any questions about this, I will go over these in future videos, but if you have any questions, send me a message or a DM and I'll get back to you guys. Take care. Bye-bye.